Patty will do the roll call.
All right. Please respond if you're here, because I can't always tell from the buttons at the bottom of my screen. Landon Moore.
I'm here.
Here. Danny Covey.
Here.
Mark Gardner.
Here.
Joel Hawkins. David Holly.
Here.
Mark Munson. I think I heard him earlier, did I not?
Yeah, he was, there evidently it was 2 times on the agendas, one at 8:30 and one at 9.
Oh, okay. All right, well, we do have 4 people present, so there's an agenda.
Yeah, Mark was here earlier.
Just got a little question mark. Do we, is Mr. Glover? And then the director of HR.
She'll be joining us a little later.
And then I'm here, and Mimi's here. Thomas Shanley.
Morning.
And James Whitley. Is Suzanne online?
Here.
Suzanne
Jim's here.
Lindquist?
She is not.
Okay. Have I missed anyone? I've got Brian. Anyone else?
Derek Challenger.
Oh, Derek. Okay. I called your name a second ago and missed you. All right. If there are no others, then we have a quorum and we are ready to continue. Landon?
Excuse me. What did you say?
I said, Landon, do you want to ask for the review and approval of the minutes of the last meeting?
Yes. The meeting minutes from the last meeting were attached to the meeting invite here. Hopefully, everyone's had a chance to review. If no one has any comments, I'll go ahead and ask for a motion to approve.
So moved. Second.
I'm going to go through the roll call so I can tell who approved them. Landon? Yes.
Here. Yes.
Mr. Covey?
Yes.
Mr. Gardner?
Yes.
Mr. Hawkins is not here. Mr. Holly?
Yes.
And Mr. Munson. Very good. Thank you. Minutes are approved. We do not have the historic flow of funds, I don't believe, right now. Unless, were they attached, Mimi?
No.
Okay. But I did want to point out that the OPEB Trust has not sent out their most recent report. So the most recent information I have is the September 30th numbers, which is the 4,577,445. As soon as the updated numbers come out, I'll send them out to you. In terms of the flow of funds, is going to give you a status of the funds in his briefing coming up.
Okay, thanks.
Landon, I've got a question on old business. My understanding is there was a presentation made to the City Council in January. Is that correct?
Yes. So there was a staff presentation that was primarily to get the new council members up to speed. I just primarily just listened in. I spoke for 1 minute at the beginning just to introduce myself, and then Mimi and Patty, and also Greystone and John Hancock probably presented for 15 minutes total. There were a few questions from council members that I think were followed up on, but I'd have to defer to Miss Terry on the follow up there. Yeah, it was a pretty brief review, Dave, and
No surprises or no concerns or anything.
If I may, I can comment that the questions really centered on who is receiving benefits, what departments do they represent, and what is the average amount of the monthly benefit. And that information has been gathered but not yet provided.
Okay. Thank you.
And just one more comment. So I don't think that technically counts as sort of the joint work session meeting. That was more of a staff presentation to council, right. And there was a whole bunch of other agenda items. Ours was just one of many. So I guess at some point we'll have a sort of a full board meeting with council, but I'll I guess Miss Terry or Phillips will let us know.
Yeah, I think they may be waiting for the new city manager to come aboard. Of course, we've had the new council, and that was kind of an introduction. But I think they're waiting for the new city manager to come aboard before we go full blown to have a full meeting.
That makes sense.
Okay.
Anybody else before we any other questions or anything before we move on to Greystone reviewing the investment performance for the calendar year?
I have no questions. No. Move forward, as they say.
Or actually, I have a question. Do we have any new board members? The
Derek?
terms usually expire at the end of the year, or September or something.
Not of yet. Not that I'm aware of.
Okay. Do we still have a full board? Are we looking for additional members?
It's my understanding that we are short one board member.
Okay. We can, I guess discuss that later about any interest of filling if we've seen any interest in that spot, or if maybe you need some help from us to find somebody.
I'll follow up with respect to that request.
Okay. All right. I guess Brian, go ahead and take it away.
Great, thanks, Landon, and good morning, everyone, and thanks, Tom, for driving here. I'm going to talk a little bit about capital market returns in calendar year 2020. I'm going to focus my comments there, but also a few comments around the fourth quarter of the year as well. Tom, can you move ahead to the next slide? Next one. Yeah, next one. Tom, can you forward one more slide? Well, I am not. There we go.
Brian, are they moving for you? Sorry.
Yeah, I see it now. So I'm going to talk about returns for 2020. I'm going to turn it over to Jim to talk about the outlook, and then we'll get back into the portfolio like we always do. Go back one more slide, Tom. Go back one. So the fourth quarter was quite a strong finish to what was an incredibly interesting year. We saw, Tom, I think there's a lag in the forwarding of the slides, but if you go back one more, sorry, this is proving to be challenging. But the fourth quarter was a strong finish to an interesting year. Interesting is probably an understatement. In the early part of the year, obviously we saw capital markets down significantly, with the S&P was down, call it in the 30% range. Global equity markets down to a very similar extent as the coronavirus spread from other parts of the world, made its way into Europe, and then eventually this country, and we all know what's happened since then. The government stepped in at that point and threw essentially an infinite amount of money at the problem, supporting capital markets, supporting the economy, implementing various programs to ensure individuals can meet their expenses as they were unemployed, that companies can still continue to operate and borrow capital either directly from the federal government or through the capital markets, and that liquidity and support of the federal government, both from direct payments and then from the Federal Reserve keeping interest rates zero for a very long time, caused the market to rally very, very quickly. And so, Tom, can you go back one more slide?
Hey, Brian, I don't know if you can reference a page number or a heading. I'll try to get
Page
the right
5.
one.
Page 5.
Good. Thank you. Page 5 is up.
So I still see page 6, but
I see 5.
Okay, all right. So page 5 shows the returns of the global equity markets, and I'm going to focus on 2020. So although we were down, in the 30% range early in the quarter, we finished the year quite strongly, where we finished on the S&P 500 up about 18.5%. So I've had a number of calls like this with clients, and it never ceases to amaze me how strong of a year 2020 was, despite the volatility we experienced early in the year. 18.5%, well above the historical norms for equity markets. Again, given where we were in February and March of 2020, never ceases to amaze me how strong of a second half of the year 2020 was. You go down the 2020 column there, and you can see that the different areas of the capital markets, the Russell 2000 index, which is an index of small cap stocks, up about 20% in the year. Go a little bit further down, you can see non-U.S. equity markets, the MSCI EAFE index up 7 or 8%, emerging markets up 19%. So U.S. equity market, like it does during a lot of crises, whether it's economic crises or healthcare crises that we experienced in 2020, leading the global equity markets higher. And a big reason for that is the fact of all the stimulus and the support from the federal government, both on the monetary side and the fiscal policy side. If you can move to all segments of the equity markets were positive during the fourth quarter. The markets and sectors of the economy that were hit the hardest during the coronavirus declines rallied the strongest, things like energy, financials. You can see that on the table on the right-hand side at the top. We show the 11 sectors of the S&P 500 index. But still for the year, energy stocks and financial stocks were negative. Energy stocks being significantly negative for the year given the drop-off in economic activity. But those kinds of companies are performing quite strongly in the first part of 2021. I'll talk a little bit about how January of 2021 is looking, but that just gives you a sort of a backdrop as to how the equity markets, the global equity markets performed in the quarter and the year. The fixed income markets were quite strong as well. Tom, if you can move forward to the next slide. Investment grade bonds, which is government mortgages, and investment grade corporate bonds were up about 7.5% for 2020, reflective of interest rates declining to near zero levels. So if I were just to sum up 2020, interesting year to say the least, but a very, very strong year from a capital market perspective, not only here in the US, but globally as well. So with that, I'm going to turn it over to Jim. We'll come back and talk about how this impacted our funds returns. But I want to turn it over to Jim to talk a little bit about what our outlook is going forward.
Great. Thanks, Brian.
It's wonderful
to be here with you all this morning. Of course, we wish we could be there in person. I'm going to ask you to turn to slide 7. So some of these slides
we've discussed
previously. Do you have an echo there?
There is a little bit of an echo, Jim.
Okay. Is that better?
I think so.
Okay. Thanks, Doc. Okay. So I'm going to review some of these slides with you this morning. Some of these relate to themes we've talked about before, but I think they're worth re-emphasizing. To be clear, we think we're in a new economic cycle. The new bull market is alive and well. Brian will come back and talk about January's results preliminarily in just a minute. But we were off to a great start in January until we hit a rocky road with some of the self-directed investor market deciding to squeeze some of Wall Street's titans, particularly in the hedge fund space. And I'll spend a few minutes talking about that later in my comments because that's a pretty high-profile situation at the end of January. As I said, the economy is performing very well. Let me give you a couple of examples that support that. First, the yield curve, which is something we look very closely at, is starting to steepen. And by that, we mean short rates are below longer-term rates. And this degree of steepness is something that we haven't seen now since 2017. We're starting to see car sales rebound. Home sales are surging. As it relates to the virus, we're starting to see hospitalizations and death rates roll over, which is critically important for the reopening of the economy. And then in terms of corporate earnings, we saw fourth quarter earnings, which is now almost complete. We saw revenue growth of over 4.5% and earnings growth of about 10%. So from a corporate profitability standpoint, the recession is over. And we realize that there are a lot of individuals and small businesses still hurting, but from a large corporate standpoint, the recession is over. Our V-shaped recovery playbook, we've been talking about now with you since the end of March, early April, has worked really well. But some of those returns have been pulled forward. I'll spend a few minutes talking about that when I go through some of the graphs in our deck today. We all know the economy is recovering, and that shutting down the economy is much easier than reopening one. But when the reopening begins in earnest, we think it's going to be extraordinarily good. There's a lot of pent-up demand. In fact, we are targeting 10% nominal GDP growth for the year, and this is something we haven't seen since 1984. So very, very strong and sharp recovery. Our non-consensus view is that the economy is going to reopen faster than most people expect. A couple challenges that come with a roaring economy. One is a lot of the good news is already priced into equities. We'll look at that more closely in a minute. And that will create some cost pressures. We're anticipating some inflation along the way. So before I go through additional slides in the meeting book, let me just spend a minute or two talking about what happened at the end of January. And there's some stocks that got swept up in a short squeeze, names like GameStop, which was on the forefront of every business media outlet, names that most of us haven't heard. So let me just walk you through just a couple of minutes what happened there and our key takeaway. One is that we entered the year with a lot of leverage from hedge funds, leveraged in the self-directed channel. For example, we saw lots of call option buying activity. We saw very high levels of margin at the self-directed channel. So things were ripe for some type of setback. So what happened? Hedge funds own names that were exposed to small cap, so small companies to begin with, and these trades were extremely crowded. So a lot of other investors owned and were short these same names. They applied leverage to these names, and many of these names were already exhausted stocks and had experienced dramatic price declines before the end of January. Some of these stocks have been down 80-90%, very broken business models. And they still had very high shortage ratios. They were low dollar price stocks, and it was really a handful of stocks that were the center of attention at the end of January. So what happened? So we're in the middle of a pandemic. The Fed has injected lots of cash into the economy, into the hands of the consumer. We have extraordinary social media access. There's no commissions for trading stocks on platforms like Robinhood, and you can trade from your phone on your couch. So a coordinated effort around social media to buy certain stocks created this tidal wave of buying stocks that are short. Stocks are short. The bet is that the price will continue to go down. So this caused a surge in the stock price of some of these small companies of 300% to 400% in just a matter of days. It was a short-term epic battle of Wall Street versus Main Street, and there was certainly losses on both sides. A couple of key takeaways from that event was certainly that the hedge fund community has been reawakened regarding new risk management tools. I think they're going to be very careful to disclosing their short positions other than where they have to from a regulatory standpoint. But the key here, and this is a question we've had on numerous calls with boards this year, and that is that this is not the beginning of a structural shift that's going to take down the market. There was some concern that this was going to have a spillover or knock-on effect for the rest of the stock market. We just don't think that's the case. So to put it in context, the market cap of all of the stocks involved in this short selling storm had a market cap between $50 and $80 billion. So that $50 and $80 billion represents about one company in the S&P 500. So hopefully that puts that in perspective for you that, yes, while it was headline news, it's not something we think that is going to be a structural shift and damage the market. Today, the speculation seems to have moved to the cannabis stocks, but here we are another day. Any questions on what happened there end of January? If not, I'll move to another slide. All right, now can we, sorry. Slide 8. Yep, perfect. So this slide just shows the fiscal deficit that we expected for 2020, and I think the key here is we're expecting another huge $1 trillion package. Matter of fact, it could be 1.5 trillion by the time all is said and done. So this will make the second year in a row that we'll have a 15% fiscal deficit. And we really haven't seen anything like this since the tail end of World War II in 1946. So we could argue that we're fighting a war and the war is the pandemic and we need this amount of stimulus in our economy. We could also argue that we're overdoing it a bit and that given how well the vaccine is going. As I said earlier, we think we're going to reopen faster than expected. And in the end, we're going to probably end up with more stimulus than we need. And that statement, I think, will become more self-evident as I go through a few additional slides with you. Let's move to the next slide, Tom, slide 9. So here we're talking about fiscal spending, filling a hole or a gap. Really what we're looking at here is retail sales. And we're comparing retail sales from the sort of brown line, 2008. This is the great financial crisis, to the blue line, which is 2020 during our pandemic. And you can see that this is what we were talking about back in April, which was this V-shaped recovery. And we got above the pre-pandemic levels back in the summer. So we're above the pre-pandemic level in retail sales, and we're getting another round of stimulus. So this just supports our case that the recovery is going to be very robust.
Hey Jim,
slide.
can I just halt you for a second there? I'm getting a lot of background noise. Can people mute their lines? Somebody's got a lot of noise in the background. I think that did it. Thanks.
Yeah. Great, much better. Next slide, please, Tom. Slide 10. Perfect. So what we're looking at here is money supply, M2. So it's really M1, which is the Fed's balance sheet, and M2 and plus velocity, which is the rate at which money is exchanged in the economy, and that gets us to M2. Certainly, it shows us how different this has been since the Great Financial Crisis. And the key takeaway here is that M2 has never been this high in history. And during the Great Financial Crisis, the money primarily went to repair the balance sheets of banks, principally, and to some degree the consumer. Coming into this recession, frankly, the consumers and the bank balance sheets were in pretty good shape. And yet we're going to have another round of stimulus, incredible M2 growth. And for us, this just means we're going to start to see some inflation come back to the economy. It's a pretty good indicator of what we can expect in the future in our view. Next slide, slide 11. Certainly get some questions about inflation, gold, and stocks as inflation hedges. And what we're looking at here is the S&P divided by gold. So when the line's going up, stocks are outperforming. In 2018, gold started to anticipate a recession and perhaps some type of Fed stimulus, and gold started to outperform. Now we see stocks starting to rally, outperforming gold, and we think stocks, particularly small cap stocks, could be a very good hedge against inflation. And part of that is because as interest rates start to rise, we expect to happen, that puts pressure on gold, of course, which has no yield at all. Next slide, slide 12, is a look at how different types of stocks are performing. And the message here in this chart is that the market is preparing for better GDP growth with some inflation. And this is really evidenced by the incredible performance of cyclical stocks since the lows. And that's the mark point here, which is March 23rd, 2020. So that red line is the dramatic performance of cyclical stocks. Growth stocks have done very well also underneath cyclicals, but that's all been at the expense of defensive stocks. And you can see the gap versus defensive stocks is pretty substantial. It's almost 100 points. So all indicating the market's anticipating better GDP growth. If we look at slide 13, this is just looking at really the same data sliced a little bit differently. Here we're looking at different sectors of the S&P 500. Same story, cyclical stocks doing really well, whether it's the consumer discretionary, energy, industrials, or materials, all outperforming since the March 23rd low relative to some of the more defensive names like consumer staples and utilities. The next slide is a look, I like to think about it, a look at the internal health of the stock market. So this is a value line index, and it's a very broad index. I think there's about 5,000 stocks in this index, equally weighted. So it gives us a very good internal look at what's happening in the stock market. And what it tells us, just looking back 2018, 2019, that really the average stock that time didn't go anywhere. And then we had the recession, and then we had an extraordinary recovery, and the value line index broke out in the upside in November. So that just confirmed that it was a new bull market. I think we all probably realized it by that time. But a couple observations from that. One is that breakout in November into being a new bull market is very important, very bullish. But what also this line shows you, it's also very extended. So we wouldn't be surprised at all to see some form of a pullback, just given that sort of parabolic move off the lows from the end of the recession. We won't try and trade around that because it's just too difficult to predict. This leads to some questions that we have received about whether we think stocks are in a bubble. We do not think stocks are in a bubble, but we certainly see pockets of excess and speculative behavior. And we talked about some of that a few minutes ago in terms of what we saw happening in late January. Slide 15, it's just a small caps outperforming large caps. We're overweight small mid-cap stocks in the portfolio. You can see that blue line moving up shows small cap stocks outperforming. It's been the speed of the outperformance has been really dramatic. So again, not surprised to see a little bit of a pullback here. But we do expect that these small cap stocks will continue to outperform and hit new all-time highs, despite the sharp move upwards. This slide 16, I think it's a really important slide, probably one of the most important slides in our deck. And let me walk you through what we're looking at here. So we've looked at 2 or 3 slides already where we're looking at the strong outperformance of cyclical stocks versus defensive sectors in the stock market. And that's what that dark blue line represents. It's the outperformance of these cyclical stocks. You can also see that this cyclical versus defensive stock ratio tracks pretty well with the 10-year Treasury. And it stands to reason. as the economy does well, the economy does better, the economy reopens, cyclical stocks tend to outperform. Earnings should be growing faster than defensive. That should mean typically that interest rates will rise as well. But in this case, there's a gap. 10-year treasuries at 1.15, as we speak, 1.16, and so why is this happening? Well, one is I think there's a skeptical view whether if inflation comes back, whether it's transitory inflation. So it's just a result of all of the stimulus, and once the stimulus wears off, we'll be back to this really low inflationary world that we live in today. And then there's some views or concerns about the Fed and whether the Fed is arbitrarily compressing interest rates, not only certainly on the short end, but it's having implications on the intermediate long end of the curve as well. Our view is that the markets will end up, rates market will end up playing catch up because the Fed is usually reactionary. So if we're right, all of this stimulus, this faster than expected reopening of the economy, next fiscal package, $1.5 trillion, will all result in an economy that is potentially going to be booming and starting to see some inflation, and rates will rise into that. Frankly, it's kind of hard for us to believe that the 10-year treasury is going to stay at 110, 115 if we're remotely close to our 10% real GDP number. The other key takeaway from this chart is that when the rates market does catch up, that could cause a valuation correction. So when we're asked, well, what are you concerned about? What do you think could drive a correction in an economy that's opening up faster, vaccines coming to the market? Certainly across the United States, yes, the pace could be faster, but it's here. There's light at the end of the tunnel. Well, it is a result of a booming economy, and it's a rate spike. And when that happens, historically, we have seen a valuation correction. So very, very important slide, and we'll continue to focus on this, and I'm confident that we'll be reviewing this at our next meeting. The remaining slides are effectively just looking at the same data a slightly different way. So for sake of time, I'll end my comments here, I'll turn it back to Brian unless you have any questions for me.
This is Landon. What is your do you have a sort of 1 year view on the 10-year and inflation in general? And your comment on will inflation be transitory? Do you think the Fed's gonna meet or exceed the 2% average target now?
Yes, good question. So we think that all of this stimulus, a faster than expected reopening of the economy, will get inflation north of 2%. And we have a 1.5% target year-end 2021 on the 10-year, and a 2% target at year-end 2022. And it's just difficult to tell whether it's transitory because there's just a mountain of stimulus coming at the same time. I think if we were pressed to answer the question, we think rates will move up to 2.5%. We'll probably have a recession in the next 3-ish years. And I think it's an important point is that given this V-shaped recovery, we didn't see the recovery we saw in 2008 that took years and years and years to develop. This seemed to happen very quickly. So the cycle is likely to be shorter. And then we go through the next recession, rates come back down. And coming out of the next recession is where, if we had to place a bet, we think interest rates could go back to 4 to 5%.
Thanks.
Sure. Okay, Brian, I'll
Any
turn
other
it back to
questions for
you.
Jim? Yeah. Great. Thanks, Jim. Tom, if you can go to slide 25. So I'm going to come back to a lot of the comments I made about 2020 capital market returns, weave in some of the comments Jim made about outlook, but focus in on this slide here, how our portfolio is structured. And then finally, get into results, which I'll foreshadow a little bit, have been quite good in 2020. So here is a snapshot of the asset allocation at the end of the year. Just focusing in on that table on the bottom of the slide here in the middle column of numbers. This is our portfolio's weight to the various asset classes. At the end of the year, 74.5% allocation to equities globally versus a target of 70%. So this overweight, this 4 or 5 percentage point overweight to stocks, as the stock market significantly outperformed the bond market, was a good thing for us. We were able to participate in the recovery, as we talked about, much more significant and much more rapid than anyone expected. That overweight added to our returns when we talk about results. Within equities, we're overweight both to U.S. equities, 43% versus 40%. But within U.S. equities, we're overweight to the smaller and mid-cap names. Again, that's been a good place for us to be, given that that area of the market recovered much more rapidly than large caps did. As Jim talked about, large caps did well, but it was the small and mid cap stocks that did particularly well. So again, that decision and that overweight helped us during the course of 2020. We also show an overweight to international equities of 31% versus roughly 30%, but within international equities, we're overweight to emerging markets. When we talk about emerging market results, you'll see that we were in some managers, both of which outperformed during 2020, but one significantly outperformed. So that, again, overweight helped us. The fact that we're overweight equities means that we have to be underweight somewhere. That's within fixed income, 19% versus 22%. And within fixed income, we have an out of benchmark allocation to high yield bonds. And as the equity markets recovered, high yield bonds or lower quality bonds did better than investment grade. So again, that decision helped us as well. We're also slightly underweight alternatives, both on the hedge fund side. And I think this is the first time since we've started, or one of our private real estate managers, Oak Street Real Estate, started to call capital. So we've got a little bit of money invested in some private real estate right now. These are very high quality names. It's often referred to as triple net lease that pays, the income off of that investment is somewhere in the 7-8% range. So very, although you won't see it in the numbers, we expect a very strong start to this fund as real estate prices have been somewhat depressed, but focus on these high quality tenants that are paying large amounts of income, I think is a good place for us to be going forward. So all of our exposures are in line with our investment policy statement and the ranges that we're allowed to operate within. The decisions that have been made both to overweight equities and then within equities, certain areas of those global equity markets have been a good decision to make and have added to returns. Tom, if you can go to the next slide, 26. So here is a look at total fund results. I think this is, sorry, 26 hasn't popped up on my slide yet, on my screen. But these are the results not only during the fourth quarter, but for the full year 2020. You can see our results have significantly exceeded those of the benchmark. So our return on a net of fee basis was 16.5%. and our benchmark's return was 14.2%. So we outperformed in 2020 by 2.25 percentage points. And our return is important to keep in mind that our return is net of all fees and expenses. So we've outperformed by 2.25 percentage points during the year 2020. Actually, our 16.5% return for the year 2020 ranks in the top 10% of the returns earned by other public retirement systems. So again, 2020 was a very, very strong result, not only given what was going on in the capital markets and the volatility that has been experienced during the year, but also very strong relative to other public retirement systems. In fact, it's interesting when you compare 2020 and 2019's results. These are the first 2 full calendar years since the mandate changed in late 2018 to be discretionary. And 2019 was an exceptionally strong year as well. So if we took 2020's return, and this isn't shown on this slide, by the way, but if we took 2020's return and 2019's return, we're up in the 16 to 17% range per year over those 2 years. And that result ranks in the top 5% of returns earned by other public retirement systems. So again, I just want to reiterate how strong these 2 calendar years were, not only in terms of absolute numbers, but relative to our benchmark and relative to the returns of other public retirement systems. Since inception of this discretionary mandate, which includes the fall of 2018, we're up on a net of fee basis a little more than 16.5% versus 14.5% for the benchmark, 2% per year. As Jim mentioned, January got off to a pretty good start, and then we saw a fall off later in the month. We estimate for our public markets investments we were flat in January, and our benchmark was down about 0.5%. So again, it's relative to the benchmark. 2021 is off to a good start. Obviously, we want to see positive results. We don't want to be flat, but anytime we can go down less than what the markets do and what our benchmark does, that means we have to go up less in order to compound capital over the long run. Tom, if you can go to slide 27.
Hey, Brian, just a quick question.
Yep.
Yep. You've done obviously well compared to our current benchmark.
Yep.
But I think also what's been an improvement here that probably gets missed is we have a better allocation than we had prior to October 2018. There was a big allocation to that one fund, that Schaefer-Cullen fund, and you, since you cover that, you might actually know how it's performed. But I think it's safe to say that if we had continued with the old allocation, we wouldn't be, the benchmark return wouldn't be near as high as what we're currently our current benchmark has done the last 2 years. You think that's safe to say?
Yeah. Very safe to say, Landon, and you're absolutely right. So we had let's just call it a healthy allocation to a firm called Schaefer-Cullen. Schaefer-Cullen is a large cap value stock manager, number one. And up until maybe the last several months, value stocks have dramatically underperformed growth stocks. So Schaefer-Cullen had that going against them. The other thing that they did with that portfolio is they sold call options on the names that they owned. So in effect, what they did was they capped their upside on those stocks. And so as the markets rallied really over the last couple of years in particular, that portfolio, because it had value stocks and because it was selling away a lot of the upside, dramatically underperformed what we've actually earned. So the shift in strategy absolutely positively benefited us because we have a better strategy in place going forward, number one. Number two, the managers we've added to the mix and our ability to make quick investment decisions within the confines of the investment policy statement, those decisions added a significant amount of value. We added some high yield bond exposure in April and May of this year. During the equity market declines in February and March, we sort of rebalanced the portfolio to take advantage on a lot of the sectors of the equity markets that were hit particularly hard. That's really helped. We've overweighted emerging markets, and I'm going to show you that that's really helped. So it's really a combination of, yes, we've got a better strategy in place, Landon, and then within that strategy, a lot of the decisions that were made on a timely basis really contributed to those impressive results, I would say.
So thanks, Brian. So, when we looked at the previous slide over the last 2 years and a couple months since this mandate, the benchmark was 14.5. Our return's been 16.5. But if you had looked at our old strategy, the benchmark return would have been south of the 14.5. So we've sort of won by an improved strategy and also better sort of management and execution along the way as well.
If I had to guess, and this is just a guess, and we can do the analysis to see what it actually was. If our benchmark's return was, let's just call it 14, I'm going to guess the old benchmark would have been 11, 12 maybe. And with the old managers we had in place, we would have probably been sub 10% return.
Yeah.
And again, that's don't hold me to those numbers, but just kind of knowing the strategy that was in place back then and the significant changes that were made, that's, again, my sort of educated guess here.
Landon, I would agree with that, because if you recall that value line index that we saw, at the end of the recession, it was almost straight up to new highs. And that is a very, very challenging market to be writing covered call options. So that strategy tends to do well when the market is grinding higher. But when you have these extreme moves, those call options get called and your equity allocation gets taken out of the market. So yeah, I would be surprised if it was double digits. My guess would be it would be upper single digits.
Thanks.
Here on slide 27, we're just doing a little bit of attribution, and this is for the fourth quarter. I'll give you a sense as to how 2020 looked, but I just want to kind of explain what some of these numbers mean. So our benchmarks return in the fourth quarter on the far left-hand side was 10.97%. So if we invested passively at our target weight, 70-30 stocks and bonds, roughly, I know there's some alternatives in there, but we would have earned a 10.97% return. If you go all the way to the far right-hand side, in the quarter, we generated 11.39% return. So about 40 basis points of outperformance. Now, what is that coming from? This broad allocation effect, this just looks at our overweight to equities in general and underweight to bonds and alternatives. That added about a 28 basis points of return. But it's really within the broad asset categories, that 70-30, as I talked about earlier, overweighting small cap stocks and overweighting emerging markets in particular. That's where the real juice came from in the fourth quarter of 1%. When you looked at, again, this is just for the fourth quarter, when you looked at the individual manager results, which is that selection effect, it looks like we've underperformed or those managers underperformed their sort of style-specific benchmarks. So those are the three components of our alpha. One quarter's results, not all that meaningful, particularly with the results on the selection effect from active management in any given quarter, results can be better or worse than benchmark, but over a long period of time, we expect those managers to generate returns in excess of their benchmarks. And then just to give you a sense, I took a look at 2020. So our large cap exposure, and we've got 3 investments in our large cap US stock portfolio. We have an S&P 500 index fund, which is going to generate the market's return. And then we have a large cap growth manager and a large cap value manager. Those 2 active managers in place combined earned a 25% return. And I'll get to the individual portfolio returns in a second, but those 2 managers in aggregate generated 25% return, and the S&P 500 was up 18. So very strong results on the large cap equity side for the full year 2020. On the small cap side, we have 2 managers. We have one that's a growth-oriented manager in the small and mid-cap space. We have a small cap value manager. Combined, those 2 managers were up about 15%. The benchmark was up about 20. So there was some underperformance there that we'll talk about in 2020. And then what was really impressive, and again, I'll show you in a second, we have 2 emerging market managers, one that is a sort of a growth-oriented one that is much more core, leaning towards value. The 2 of them combined were up 52% in the calendar year, while the emerging market index was up 18%. So when you extend the measurement period on the selection effect, you're going to see, and we would see positive results. It's just on this slide, we run it for the quarter, and it just so happened that several of the active managers underperformed. And we tend to see that, by the way, when equity markets rally as strongly as they did in a period as short of a quarter. We tend to see active management in general underperforming in that kind of environment. What's reinforcing and positive is, even though the equity markets rallied so strongly in 2020, we saw our active managers in general doing even better than what the markets provided. So again, very, very strong results across the board. Maybe if you can flip ahead to slide 27. Oh, that was 27, sorry. Go ahead to page 39 and we'll get to individual portfolio returns. Sorry, it takes a while for my computer to catch up to where you're going, Tom, but 39, there we go, perfect. I'm just going to focus on a couple of portfolios here on this slide, and then on the next couple of slides, touch on a few more. So about, I don't know, not quite halfway down this table, you'll see the Artisan Developing World Fund. This is our emerging market manager one of our emerging markets managers that I alluded to earlier. This portfolio was up over 81% in the quarter, which is astounding. They were up over 40% last year, by the way. And their benchmark was up 18.3%. So what was driving the results here? This is a manager that is clearly moving the portfolio around, and as the pandemic was taking its hold, first in China, and a lot of those stocks late last year got hit. And as the Chinese government got its control around the virus, granted, we have to take, news from various other parts of the world with a grain of salt because you don't really know what's going on. They were able to shift the portfolio to increase their exposure to Chinese equities, and the Chinese equity market just absolutely took off in 2020. So this manager significantly outperformed, again, on the tails of the 2019, which was another year of significant outperformance. This is a manager we had for a long time. This is a manager that we had in place before the mandate changed, but it's been a tremendous investment for us. We still feel really good, by the way, about this portfolio, and continues to do very well in the early part of 2021. In fact, yesterday it was up over 2%, while the EM index was up 1%. So again, very strong results here and a manager that we like a lot and we use across pretty much our entire book. So results there have been quite good. Towards the bottom of the slide here, Rice Hall James, I know this is a manager that we talk a lot about. They were up 24%. Their index was up 40% in the year. As we've talked about in the past, the Russell 2500 Growth Index is a really, really difficult index to beat, largely because these companies start out small and they grow quite large. I think the biggest the biggest capitalization stock in this index is somewhere around $38 billion. This is not in that cap range, a space that Rice Hall James typically invests in. They have a much lower cap than what the index does. In fact, if you looked at the Russell 2000 Growth Index, which arguably could be maybe a slightly better representation of what they're doing, that was up about 34%. So not quite 40%, but the manager still underperformed relative to that Russell 2000 Growth Index. A couple of other comments about their benchmark. Number one, 40% of the Russell 2500 Growth Index is comprised of companies that have no earnings. And it's companies that have no prospects for earnings, quite frankly. And as the market recovered and highly levered companies did better than lowly levered companies, and it was clearly a risk-on trade, those kinds of stocks, those non-earners, did significantly better than sort of the tried and true companies that have revenue growth, that have actual earnings per share growth. And that's really not a pond in which this manager, or quite frankly, most active managers fish within. The other thing I would say is, again, as you look at their benchmark, the top three holdings of this benchmark, Plug Power, Etsy, and Enphase Energy. So Plug Power and Enphase Energy are alternative energy companies focused largely on battery power. I don't know if anybody's paid attention as to what's going on in that space, but the stock prices, those companies' stock prices have rallied significantly on the belief that there's more likely to be clean energy friendly policies coming out of Washington. And so the stock prices rallied significantly, even though a lot of them don't have earnings and some of them don't even have revenue. And just to give you a sense, the biggest name in the index is Plug Power. It has revenue, it has no earnings, it has no prospect for earnings, and its stock price last year was up almost 1,400%. So as we talked about in the past, a lot of the underperformance here is a function of what they don't own versus the stocks that they do own. And it's a manager we stay on top of. It's a manager we feel comfortable with. And over a long period of time, company fundamentals are what really drive stock prices. And we would expect to see, as the economy reopens and there's a greater focus on quality companies with earnings and good fundamentals, we would expect this manager to start showing some levels of outperformance. Any questions on that? Two more slides I want to touch on, page 40. Here's a list of some of the other active managers and the other investments we have in the portfolio. The first couple of lines there, these are our large cap managers, our large cap growth manager, Poland Capital, for the year up 35%, slightly underperforming its benchmark. And the one below that is Aristotle. This is our large cap value manager, significantly outperforming. So this is where I was getting at earlier when I said our large cap investments did really well. It's the combination of those two, the fact that they do something different, and the fact that they serve a very complementary purpose. Even though one underperformed and one outperformed, in aggregate, they both significantly outperformed the S&P 500 index. About halfway down the table here, international equities. We restructured international equities during the year, where we moved out of some higher cost mutual funds and moved into lower cost separately managed accounts. The inception date of that was roughly the fall of this year. So I would say our investments in international equities for the full year did well, but this sort of shorter period of time, it's both of those managers slightly underperforming their benchmark. What we did in conjunction with the restructuring and moving out of these high cost mutual funds and into these lower cost separate accounts, however, was to increase our emerging market exposure. So all in all, that restructuring added value because emerging markets did substantially better. Our managers in that space did substantially better than what the market did. The last one, I'll just show you the high yield manager here. This is a high quality, high yield manager, and it's the lower quality segment of the high yield market that did particularly well. The companies that are highly levered, the companies that, at some point, maybe filing bankruptcy, but because of all the money that the federal government has thrown into the system and all the stimulus, it's the higher risk companies that did better than the lower risk companies. But the end result of our allocation in the space was to help us outperform our investment grade fixed income benchmark. One more thing I want to talk about on slide 41, and this is this manager shows up in our alternatives portfolio. We have exposure to a company called Renaissance Technologies, an investment manager. It's a hedge fund. It's a quantitative hedge fund. They invest across the sort of the capitalization spectrum. They invest long, they invest short, but in aggregate, they have 100% of their exposure is exposed, their assets is exposed to the equity markets after you offset their longs and shorts. They've significantly underperformed in 2020. And the reason for that is they're a very quantitatively focused manager. They invest in factors. They don't really care about what individual companies are doing. But when you have this extreme level of volatility that we experienced in 2020 and things working one day and the very next day, the complete opposite working, that volatility of factors is really difficult to time because they change literally on a daily and in some cases an intraday basis. And so that's a big reason why their performance was so bad in 2020. The other issue impacting the results is it's these higher risk factors and stocks that did well, and they tend to underweight those higher risk names and factors and overweight some of the lower risk names and factors, because over a long period of time, again, those fundamentals of those companies that are maybe lower risk and more stable matter over time, but under discrete periods like we had in 2020, where you have high risk companies and high risk factors doing so well, that contributed to their underperformance as well. We went back, there was one other period in the history of this firm, and this firm has been around for decades. There was one other period where they generated results that were slightly worse than what was experienced in 2020. In 2008 and 2009, this manager was down 25%. And I don't need to remind everybody what was going on back then, but very similar environment from a factor perspective. High levels of volatility, although it took us a very long time to recover, as Jim talked about. While we were going through that situation in the global financial crisis, we'd come into work, we'd turn on the news, and you just wondered what shoe was going to drop that day. That volatility is very difficult to navigate. I will say the subsequent 10-year period, this manager has compounded at 15 to 16% over the preceding 10 years. So it's a manager we have a lot of confidence in. It's a manager that's significantly underperformed this year. It's not out of the realm of expectations because we've seen it before. And typically what has happened with this manager is they've backed it up coming out of these environments with generating significantly strong returns. So with that, I'll stop. I talked a little bit about January. I don't know if anybody has any particular questions. Okay.
All right. Thanks, Brian. I didn't have any more questions. And if nobody else does, I guess we can turn it over to John Hancock.
All right. Thanks, Landon. Can you hear me all right?
Yep.
Okay. And in the interest of time, I promise to be brief. I will share some material, though, just to give you all a quick update. Really, the goal here is just to make sure that the board has awareness for what we're doing, what we're providing, and then providing some updates on transactional activity, et cetera. So let me just increase this. So again, sharing my screen, we generally follow an approach of each of these 4 meetings during the year, I try to highlight a couple of different specific things so that at least we're touching base, and again, that awareness is there. At the beginning of the year, I just like to check in and we take a quick look back at some of the success and some of the activity performed in the prior year. Mainly as a reminder, our function is really dealing with all the administrative and record-keeping responsibilities to ensure that individuals and retirees receive their benefit payments, providing them full services, and then obviously handling all the actuarial work that's required. And then from year to year, as different projects or requests come up, primarily bringing back Andre and the actuarial team to maybe do some analysis and look at some potential changes in funding or supplements, et cetera. We'll get involved there. And then from my standpoint, it's just, as I mentioned, bringing these updates to the board, working with the city offices throughout the year. And I think that the big thing that jumps out here is at the bottom, close to 12,000 retiree benefit payments were paid out last year. We just want to continue to keep that engine going and to ensure that folks receive their benefit payments. So won't go through all of this, but again, just documenting, the actuarial reports and the work that's done throughout the year. Being a frozen system with less and less actives, obviously there's less engagement and opportunity that we need to do, but we still want to provide opportunity and information for individuals. I'll move through this section pretty quickly just because the committee or the board here has been involved for a while, so I don't think I have to go deep into what we do. There's a couple of updates here on the organization. Just as a reminder, John Hancock in the U.S., owned by Manulife, based in Canada, but really retirement and wealth management is a global focus. So we're leading retirement and asset wealth managers here in the U.S., in Canada, and in Asia, and that continues to be the focus to grow those markets. Moving forward here, we offer what we call a total retirement offering to clients. Again, you all, City of Portsmouth, falls in this middle column of defined benefit services. But in addition to municipality, Taft-Hartley union organizations and corporate organizations, we cover defined contribution, 401k, pension, and executive benefit programs. And then the service structure, we have a team that's dedicated to City of Portsmouth. I know primarily you hear from me. We bring Andre in, who obviously probably has the main role with the pension system. But then we have a woman, Irene Burns, who does all the behind the scenes day-to-day activity. She has been down to Portsmouth before. Some individuals that help Andre, and then a woman in our communications department that we pull in as needed when we need to do outreach to participants in the plan. And really, this is just kind of an overview. I'm not going to go through this again, as I mentioned, but the services, what we provide in each of these segments, from administration, actuarial work, and expertise, and again, the communications to our participants, which, as I mentioned, is a little limited just based on the fact that the system is primarily frozen. But we do offer a lot of resources, and for individuals who we do have contact information for, we'll reach out directly to them. There are tools and resources on the website for individuals if they do want to, dig in and look a little deeper into financial wellness offerings. And then, of course, for the most part, folks are accessing us through the website, but we do obviously have a call center and deal with City of Portsmouth members on an ongoing basis. So that's the very quick summary of who we are, what we do. This is generally what I look to make sure that we're delivering to you all on an annual basis, looking at these 7 main items. Obviously attending meetings as needed, providing the annual actuarial update, going through this review, making you aware of significant changes to the websites if there are some, and data structure. Generally in one of the quarterly meetings, I'll give an update on data security. Always looking to work with the HR department on administration efficiencies if needed. I know Mr. Challenger handles your fiduciary training. We've helped a little bit of that in the past, and we always have resources and folks available as needed. And again, the actuarial and participant engagement. All right. So some of this Brian touched on, but just to highlight, year-end assets ended at just over 240 million. That's covering 1,042 individuals for both systems combined, and we'll talk about how those the status of those individuals. Brian goes into much deeper detail on the investments and asset allocation, so I don't really need to touch on that. If you look here, this is just quarter by quarter activity. This is the fire and police plan, looking at participant status. We're down to 10 actives as of the end of the year in fire and police. The vast majority are in pay. And then we do have some individuals who are terminated, but they haven't started benefit payments yet. So 41 of those. And you can see here from an active standpoint, everyone is 50 plus. That's obviously due to the system being frozen a while ago. Carrying on fire and police, this looks at quarter over quarter activity of contributions that come in, fees that are assessed and paid by the trust, and those benefit payments that I mentioned that go out monthly. This gives you a quick quarterly summary of what's coming out. So the number jumped, you'll see here in the fourth quarter, up to 6.3 million. That's because this number is including the supplement payment that the trust didn't pay, but it did flow through the system. So that's why it's picking up here. But primarily, we're looking at 5.3, 5.4 million on a quarterly basis. This is some of the detail that Patty mentioned at the beginning of the call that we've been compiling as a follow-up from the council meeting, where they were looking for some more detail around the benefit payment. So different summaries have been put together. I just wanted to share some of the stats for this group so that you did have awareness of what was asked for and what potentially is going to be provided back. Again, this looks at fire and police, summarized at the bottom here by counts based on departments. So obviously here we had just primarily the fire and then the police department. There were a handful of missing accounts. Those are in the process. Not that they're missing. What's missing is the division tag, who these people were associated to. Some of this information wasn't available when the plans came over onto our system. So I know the city is doing some research to try to add those records on. But you can see the average benefit on a monthly basis in fire and police that goes out is $2,800. The median at $2,700. And then here are those 10 active folks, all with more than 25 years of service. So, you would imagine retirement is probably coming up soon for these remaining members. And then similar information in the supplemental group, down to 12 actives in supplemental. Again, the vast majority are in pay, and then there's a handful that haven't started benefits yet. Similar information on money in and money out. And then, same thing here on the detail of the payments. A lot more departments within the supplemental plan, so a lot more breakout is shown below here. You'll see the average benefit payments are less than fire and police, with around $1,800 per check per month. Any questions on any of that detail? Okay, the last thing really for me that generally provide is just, looking back at and projecting forward that check in on overall expense to run the systems. And we've provided a couple of different views on this also that may go back to council based on some conversation. This is the view that I generally provide here on a quarterly basis. Excuse me, laying out the investment management cost, Greystone Consulting, our fees, revenue sharing, and I explained at a certain point there were some investment options that were in the portfolio that would pay back money to offset some cost. Those have been removed now, so we'll probably take this column out. But you'll see, the average cost has actually dropped a little bit further. That's due to some of this investment management expense going down. And I think Brian talked about that with some of the changes from, types of options being utilized from moving into more of the separately managed accounts and lower expense. But looking at around 52 basis points of expense, collectively sharing all of this cost to run the systems. And as I do, providing this detail based on holding, we don't get into the specifics of all of the individual holdings within what Morgan Stanley is doing, but we do incorporate that average investment expense of the assets that are held there, those being right around 30 basis points. We only hold money in the money market really in order to pay for ongoing monthly benefits, and that process is managed on a going forward basis. And then that artisan developing world, which Brian talked about, that one is still held at John Hancock. So that's a quick update for me. Happy to answer any questions if there are any. And appreciate the opportunity to meet with the board.
Tom, this is Patty. I just wanted to comment that the exercise we've gone through in identifying the departments is, I think, is going to be valuable information moving forward. So, brief council or whatever, it could probably good to kind of keep up with that. Mimi's been able to identify some of the she recognized some of the names.
Okay.
So, of course, police and fire is what they are, but and of course, I don't know that we have in the supplemental too much, but that's not, I think, is a concern. But I think that it will help City Council more fully appreciate what the big picture is.
No, for sure. And if you want to send over the departments for those missing individuals, even if you just want to shoot an email, I'll make sure we update the records in the system so that we have it.
Okay, we will get to that at some point soon.
Sure. Thanks, Patty. So I think that might be it. I'm not sure. Back to, I guess, Landon.
Yeah, I think that was all that was on the agenda that I saw, unless Ms. Phillips or Terry have anything else.
The only mention is the next meeting. I think the agenda calls for it in May, but I turn to you, Landon, about your preference on the next meeting.
So I think that may go back to our sort of rules of the board, if you will, and if Derek's still here, are we required to have a certain number of meetings per year? Just want to make sure we're meeting our obligation. If we don't need to have the meeting, then maybe we can skip it. But I don't want to want to make sure we're doing what we're supposed to be doing here.
No, there are no required number of meetings that the board has. So historically, we missed several meetings a year. So no, we don't have a minimum number of meetings that's required.
So I think we'd at least need quarterly, but in the past we had monthly meetings, which I think is probably a little bit of overkill. But you know, I'll defer to you as far as the frequency of the meetings. I absolutely think we need quarterly. If any more frequency than that is, I'll let y'all decide.
Can I suggest we will plan on at least quarterly, but we would ask Thomas and Brian that if there be any issues that would need for us to have a meeting, then we would call another meeting, an additional meeting.
Yeah, I think that makes sense. And really from our perspective, I know we've generally met on a quarterly basis while you all, the board, may have met monthly. The only exception to that is we also do generally meet in the month of October, where Andre comes and gives the annual valuation, and that's just due to timing. I'm sorry, the month of November, in addition to October, where he gives the valuation review. So other than that, from our perspective, quarterly works for us.
That
Great.
works for Greystone too. Yep.
Okay, very good.
I would agree with Landon. I think quarterly is probably sufficient unless something happens and Brian and his group think that maybe we need to get together and talk.
Yep. Agreed.
Or
I like
something that,
quarterly.
sorry.
I like the quarterly idea, and then if some alarm does come, then we rally.
Okay, so I mean, I guess if anything comes up that needs to be approved, I guess we'll have to have meetings. But otherwise, you know, I guess the vote is here quarterly.
So May's our next meeting, correct?
Yes.
Good.
All right. Meeting adjourned.
I wish everybody a happy couple of months coming up then.
I wish everybody gets their shot. Everybody get their shot.
Indeed.
Florida, okay?
Be safe.
Be well, everyone.
Thank
Thank
you.
you.
Be well.
Thank
Thanks.
you.
Stay
Bye-bye.
healthy. Bye.
Danny, Dixon.